Welcome to the knowledge of accounting. Here we will discuss how to prepare income statement, owner's security statement, and balance sheet. Income statement. Income statement can be prepared in two formats. Number one is single step income statement. Number two is multiple step income statement. Single step income statement. In single step income statement, we arrive at net income by deducting all expenses from all revenues. Again, I am repeating, when we deduct all expenses from all revenues, then we can arrive at net income. Here, all revenues include both operating revenues and other revenues and gains. Operating revenues and non-operating revenues, which is considered as other revenues and gains. On the other hand, all expenses include cost of goods sold, operating expenses, and other expenses and losses, which is considered as non-operating expenses and losses. Multiple step income statement. The multiple step income statement shows several steps in determining net income. It begins by presenting sales revenue. It then deducts contra revenue accounts, that means sales returns and allowances and sales discounts, to arrive at net sales. I mean, we start multiple step income statement with the sales revenue. Then we deduct all contra revenue accounts, I mean sales returns and allowances and sales discount, to arrive at net sales. Then cost of goods sold is deducted from sales revenue in order to determine gross profit. After that, operating, I mean administrative and selling expenses are deducted to arrive at operating income. Next, non-operating revenues and gains, which is called other revenues and gains, such as interest revenue, dividend revenue, rent revenue, gain from the sale of property, plant and equipment, etc., are added. And non-operating expenses and losses, which is also considered as other expenses and losses, such as interest expense, casualty losses, loss from the sale or abandonment of property, plant and equipment, etc., are deducted to determine net income. Now we can see owner's security statement. An owner's security statement summarizes the changes in owner's security for a specific period of time. It shows the changes in the capital account due to the additional capital, withdrawals, and net income or net loss. So if we summarize owner's security, we can reach at the owner's security if we add initial capital with additional capital and net income. I mean, we add additional capital and net income with initial capital, and then we deduct drawings to arrive at owner's equity. Now, balance sheet. The balance sheet presents a snapshot of a company's financial position at a point in time. That means a balance sheet is a snapshot of financial position of a company. A classified balance sheet generally contains the following items. We can see assets. In assets section, we can see current assets, long-term investments, property, plant and equipment, intangible assets. These are the items which should be added in the assets section. After that, we can see liabilities and owner's security. In this section, we will add current liabilities, long-term liabilities, and stockholders' equity, which should be taken from owner's equity statement. Now, practically, we are going to see how to prepare financial statement from this question. Here we can see there is a question, and in this question we can see there is a adjusted trial balance. Okay, so from this adjusted trial balance we can see some ledger balances. From this ledger balances we will prepare financial statements. Okay, generally we will prepare here only three basic financial statements: income statement, owner's equity statement, and balance sheet. So now, before preparing the financial statements, let us be familiar with the items included here. Here, sales revenue, it's a income item. Okay, and then sales return and allowances and sales discount, this is contra revenue. This item is considered as contra revenue. These two items should be deducted from sales revenue to arrive at net sales. So this is a income, this is a contra income or contra revenue. After that we can see cost of goods sold. This is a expense. Then we can see salaries and wages expense. It's an expense. Utilities expense. It's an expense. Advertising expense. It's an expense. Depreciation expense. It's an expense. Freight out. It's an expense. Insurance expense. It's an expense. Then we can see interest revenue and gain on disposal of plant asset. These two items, interest revenue and gain on disposal of plant asset, this is a non-operating revenues. That means other revenues and gains. Then we can see interest expense and casualty loss from vandalism. These two items, interest expense and casualty loss from vandalism, they are considered as non-operating expenses and losses, as well as this they also consider as other expenses and losses. So these are the items. While we are preparing income statement, we will transfer these items to income statement. Now we can see owner's capital. It's an item of owner's equity statement. Additional capital, it should be added with owner's capital, and here we can see owner's drawing, it should be deducted from capital. So these three items should be transferred to owner's equity statement. Now we can see cash, it's current asset. Short-term investment, it's current asset. Accounts receivable, it's a current asset. Notes receivable, it's a current asset. Inventory, current asset. Supplies, current asset. Prepaid expenses, it's a current asset. Prepaid insurance, current asset. Investment in stock of other corporation, this is considered as investment. So here there are three investment. One is investment in stock of other corporation, and then we can see long-term investment in securities, and then we can see investment in real estate. So these three items should be shown in the balance sheet as an investment, and these items are considered as current asset, which should be shown in the balance sheet in the asset section. And these three items is considered as investment, and they should be shown in the investment section. After that we can see land, it's a long-term asset. Buildings, it's a long-term asset. Plant and machinery, it's a long-term asset. Equipment, long-term asset. And after that we can see accumulated depreciation equipment, it's a contra asset of equipment. This item is a contra asset of equipment, and this contra asset should be deducted from equipment. Okay, I'm repeating this. These items are considered as long-term asset. Generally we tell them as a property, plant and equipment. After that we can see goodwill, patents, franchises and trademarks. They are considered as intangible assets. Okay. After that, we can see notes payable. It's a current liability. Then accounts payable. It's a current liability. Then we can see current maturities of long-term debt. It's a current liability. Taxes payable. It's a current liability. Accrued expenses payable. It's a current liability. Salaries and wages expense. It's also a current liability. Unearned service revenue is also a current liability. Notes payable, current liability. So these items are considered as current liabilities. Okay. After that, we can see mortgage payable. It's a long-term liability. Then we can see deferred income taxes. It's a long-term liability. Then it's called long-term debt. It's another long-term liability. So this three item is considered as long-term liability, which should be shown in the balance sheet in the section of long-term liabilities. So now from this question we are going to prepare income statement. Again, I am repeating that this item will be transferred to income statement. So let's see. Here we have shown sales revenue 48,000. Here we can see sales revenue 48,000. So from the question we have taken this sales revenue 48,000 in the income statement. Then in the question we can see there is a contra revenue, sales return and allowances, and sales discounts. We will deduct these two items from the sales revenue. Let's see. Here we can see less sales returns and allowances and sales discount, which is total amount is 2,000. Okay, so this 2,000 is contra revenue. We will deduct this 2,000 from 48,000 to arrive at net sales. So here we can see the amount of net sales is 46,000. Then from the question we will take this item. This is called cost of goods sold. It's an expense. Here the amount of cost of goods sold is 31,600. So we will take this 31,600 as an expense in the income statement. Here this is net sales 46,000. So from this net sales we will deduct cost of goods sold with the amount of taka 31,600. So after deducting we will get this item, which is considered as gross profit. So here the amount of gross profit is 14,400, and we will get this amount after deducting cost of goods sold from net sales. Again we are taking the expenses. Here salaries expense, utilities expense, advertising expense, depreciation expense, freight out, insurance expense. These expenses are considered as operating expenses. We will deduct these expenses from gross profit. So here the gross profit is 14,400, and we will deduct these items. Here we can see salaries and wages expense, utilities expense, advertising expense, depreciation expense, freight out, insurance expense. So these are the total operating expenses. So here the summation of total operating expenses is 11,400. This is total operating expenses. We will reach at this amount after summation of such operating expenses. So this is the total operating expenses, which is 11,400. So now we are going to deduct this 11,400, which is considered as total operating expenses, from the gross profit. Here the gross profit is 14,400 and the total operating expenses is 11,400. So if we deduct this 11,400 from 14,400, we will get 3,000, which is called income from operations. Here the amount 3000 is called income from operations. From this income from operation, we will add other revenues and gains, and we will deduct other expenses and losses. Okay, so from the question we can see here there is a two non-operating revenues and gains. This can be considered as other revenues and gains. Here interest revenue is 300 and gain on disposal of plant assets 100. This two item is considered as other revenues. These two item will be added with the income from operations. Here income from operation is 3000. With this amount we will add other revenues and gains. They are interest revenue 300 and gain on disposal of plant assets 100. So if we add these two items, the amount will be 400. This 400 is considered as the amount of other revenues and gains. We will add this 400 with the income from operations. This is income from operation. This is other revenues and gains. We will add this 400 with this 3000. Okay, after that from the question we can see there is another two item such as interest expense and casualty loss from vandalism. These two items are considered as other expenses and losses or non-operating expenses or losses. So if we deduct this amount, here we can see other expenses and losses, interest expense 180 and casualty loss from vandalism. This is another other expense which is 20. So if we add this amount we will get 200. So here we can see there is a bracket which is showing that this should be deducted from the income from operation. Here 3000 is the income from operation. We will add this 400 with this amount and we will deduct this 200 with this amount. So if we deduct 200 and if we add 400, then we will reach at 3200, which is considered as net income. So this is the net income. Again I am repeating, this is the sales revenue. From this sales revenue we will deduct contra sales items. If we deduct this contra revenue we will reach at net sales. From this net sales we will deduct cost of goods sold. After deducting cost of goods sold we will arrive at gross profit, and from this gross profit we will deduct all the operating expenses. So after deducting all the operating expenses we will reach at income from operations. So after that we will add other revenues or gains, then we will deduct other expenses and losses to reach at net income. Here the net income is 3200. Dear audience, this is the format of multiple step income statement. Okay, so we have prepared this with the help of multiple step income statement. If we prepare this income statement as a single step income statement, that will be in this format. Okay, here we can see it's a income statement which is prepared on the basis of single step income statement. In this single step income statement, in the first stage we will show all the revenues, and in the second step we will deduct all the expenses. Here we can see the net sales 46,000, then we can add interest revenue and we can add other gain which is called gain on disposal of plants. We have added all the revenues in the first section which is 46,400. So in this single step income statement, in the first stage we will show all the revenues, and after that we will deduct all the expenses such as cost of goods sold, then all total operating expenses, then interest expense, then casualty from vandalism. These are all the expenses and losses. So the total amount is 43,200. So here the amount 46,400. This is the total revenues, and here the total expenses 43,200. So if we deduct this 43,200 from total revenues, then we will get net income. And such type of income statement is considered as single step income statement, where we will show all the revenues in the first step, then we will deduct all the expenses from the revenues. Now we will prepare owner security statement from this item: owner's capital, additional capital, owner's drawing. Let's see how to prepare owner's security statement. Here we can see owner's capital. This is the opening capital, which is 31,800. From the question we can see the owner's opening capital is 31,800. It will be shown in the first section in the owner's equity statement. Here the opening capital is 31,800. Then we will add this amount, which is additional capital, with the amount of taka 10,000. Here we will add this additional capital 10,000. Then we will add net income, and this amount will be taken from the income statement. Few minutes ago we have prepared income statement. From the income statement we will take this amount, net income, which is the 3,200. For your kind information, I would like to mention here that if there is a net loss, then we will deduct this net loss from the owner's capital. I mean, when we prepare income statement, if the total expense exceed the total revenues, then we will get net loss, and net loss should be deducted from owner's capital. But in this math, we can see there is a net income from the income statement, so this net income should be added with the opening capital. So this is the opening capital 31,800, this is the additional capital 10,000, and this is the net income 3,200. These two items should be added with the opening capital. So the total amount of additional capital net income is 13,200. If we add this 13,200 with the 31,800, we will reach at 45,000, and with this amount we will deduct drawings. So if we minus this amount 10,900, it's drawing. So after deducting this drawing, we will reach at the closing capital, which is 34,100. So this is the owner's equity at the closing time. Now we are going to prepare the last part of financial statement, which is balance sheet. So we will prepare the balance sheet by using these items. Okay, here we can see cash and short-term investment. So here cash 6,600, short-term investment 2,000, account receivable 7,000, notes receivable 1,000, inventory 3,000, supplies 1,100, prepaid expenses 1,000, prepaid insurance 400. These are the item of current assets. We will take this amount to asset section of balance sheet. Let's see, it's a balance sheet, and this balance sheet is prepared on a specific date, and income statement and owner's equity statement is prepared for a year or particular period, but this balance sheet is prepared for a particular date. So we have taken these current assets from the questions: cash 6,600, short-term investment 2,000, account receivable 7,000, notes receivable 1,000, inventory 3,000, supplies 1,100, prepaid expenses 1,000, prepaid insurance 400. These are the items of current assets. So we need to sum up these items. Here the total amount is 22,100. This is the total current asset with the amount of 22,100. Let's see the question again. After that we can see three items. Here the three items is investment in stock of other corporation, long-term investment in securities, investment in real estate. These are the items considered as asset, and it should be shown in the asset section. Here we can see the three items: long-term investment, investment in stock of other corporation 3,200, long-term investment in marketable securities 2,000, and investment in real estate 2,000. These are the long-term investment. If we sum up these three items, we will get 7,200, which is the total investment. This is the total investment, and this is the amount of total current asset. This is the total investment. Let's back to the question. After that we can see some items. These are the items which are considered as long-term asset, or otherwise it can be considered as property, plant and equipment. Here we can see land 4,000, buildings 6,000, plant and machinery 9,000, equipment 15,000, and accumulated depreciation equipment 5,000. Be careful, this is the contra asset. This contra asset should be deducted from equipment because it's the contra asset of equipment. Okay, so we will take these items to the assets in the balance sheet as a long-term asset or property, plant and equipment. Here we can see the property, plant and equipment. The items in the property, plant and equipment are land 4,000, buildings 6,000, plant and machinery 9,000. Here we can see the equipment is written in the inside column because we need to deduct this contra asset of equipment. I mean this accumulated depreciation. Equipment is a contra asset of equipment which should be deducted from equipment. So if we deduct this 5,000 as accumulated depreciation, which is the contra asset of equipment, we will reach at the final value of equipment, which is 10,000. So this is the book value of equipment. If we deduct this accumulated depreciation of equipment, that means contra asset of equipment, from the equipment, we will reach at 10,000. This is the book value of equipment. So this is land, this is buildings, this is plant and machinery, and this is equipment. So if we add these items, we will reach at total property, plant and equipment, or total long-term assets, or total property, plant and equipment. So now we will add these three items. Total current asset 22,100, total investment 7,200, total property, plant and equipment 29,000. As well as get back to the question, we can see there is intangible assets, goodwill, patents, franchise and trademarks. These are the examples of intangible assets, the asset that cannot be touched. Okay, they are intangible assets. These assets should be added in the last section of assets. So here intangible assets, goodwill, patents and franchise and trademarks with the amount of taka 3,100. So this is total current asset, this is total investment, this is property, plant and equipment, and this is intangible assets. If we add these four items, 22,100, 7,200, 29,000 and 3,100, the total amount will be 61,400, which is considered as total assets. This is the amount of total assets, which is 61,400 total assets. Now get back to question. From these items we will prepare the liabilities and owner's equity section. Okay, so in the first section we will take all the current liabilities. Here we can see notes payable 6,500, accounts payable 2,100, current maturities of long-term debt is 1,000, tax payable 2,000, accrued compensation payable 1,500, salaries and wages payable 1,600, unearned service revenue 900, interest payable 400. These are the examples of current liabilities. These are the current liabilities. We will take these current liabilities in the liabilities section. Here you can see current liabilities. So the current liabilities are notes payable 6,500, accounts payable 2,100, current maturities of long-term debt 1,000, taxes payable 2,000, accrued compensation payable 1,500, salaries and wages payable 1,600, unearned service revenue 900, interest payable 400. These are the examples of current liabilities. If we sum up these amounts, we will get 16,000. So this is the summation of total current liabilities. Okay, after that we are going back to the question. Here we can see three items: mortgage payable 4,000, deferred income taxes 6,000, long-term debt 1,300. These three items are considered as long-term liabilities. Now we are going to show these long-term liabilities in the long-term liabilities section. Here long-term liabilities, there are three items. We can see mortgage payable 4,000, deferred income taxes 6,000 and long-term debt 1,300. These are the items of long-term liabilities. So if we add these three items, we will get 11,300. This is the total long-term liabilities, and this 16,000, it is the total current liabilities, and this 11,300, this is the total long-term liabilities. So now we are going to sum up all the liabilities, current liabilities and total long-term liabilities. Current liabilities is 16,000, long-term liabilities is 11,300. If we add these two items, the amount will be 27,300, which is called total liabilities. And with this total liabilities, we will add owner's capital, and this item should be taken from the owner's equity statement. Total liabilities 27,300, and here the total owner's equity is 34,100. If we add these two amount, then we will reach at 61,400, which is the total balance of total liabilities and owner's equity. Here you can see the total asset is 61,400 and the total liabilities and owner's equities are 61,400. So assets are equal to liabilities and owner's equity. Accounting equation has been proved that assets should be equal to liabilities and owner's equity. Here asset is 61,400 and the total liabilities and owner's equity is 61,400. So this is the balance sheet. Again I am repeating, in the balance sheet we show assets in the first section. Here these are the assets. The total amount of asset is 61,400, and in this section we have shown all the liabilities and owner's equity. So here this is the 16,000 current liabilities, this is the 11,300 long-term liabilities, total liabilities 27,300, and total liabilities and owner's equity 61,400. Asset should be equal to liabilities and owner's equity. Thank you.